Hi there, this is Sandra with the Mortgage Center. Thanks so much for joining me today. Another message for you from our office if you're interested in mortgages and housing like we are. I've included a couple of really interesting, or actually three really interesting articles to this Rate Watch, and I would encourage you to read them if you have time, but I'm going to give you a really great summary. As you know, that inflation is still a persistent issue in Canada for a variety of reasons. I'm not going to get too far into that, but the Bank of Canada continues to increase the overnight lending rate, which is affecting variable rate mortgages and any sort of unsecured debt that you have, which would be lines of credit or a credit card. And so when the Bank of Canada increases the overnight lending rate, it has a direct effect on the mortgage prime rates and your variable rate mortgages. And so many of our clients right now, the mortgage prime rate is at 3.2%. We can probably expect to see another 4 to 6 rate hikes over the next year. And just a reminder, pre-pandemic, the mortgage prime rates, most mortgage prime rates were at 3.95%. So many of our clients are at 3.95 minus a half or minus a 7. So I'll let you do the math. Or if you've got a variable rate mortgage, your rates are probably in the low threes. However, the overnight lending rate doesn't affect fixed rate mortgages. The bond market does, and the bond market is influenced by inflation as well. So what we're starting to see right now, if you're looking at a 5-year fixed rate mortgage, you're looking at a rate of somewhere in the area of 4.09 to 4.29 on a primary residence. If you have a rental property, you're looking at probably somewhere in the area of 4.5%. So this is what's happening with mortgage rates. Something I wanted to also bring to your attention is we're starting to see a softening in home value. So it doesn't mean a price depreciation. If you look and compare prices in most Ontario cities versus in the same period last year, prices are still up by 18%. And what we're starting to see is sort of a more gradual shift of, homes not appreciating by 20 or 30% year over year. What we're also seeing in our office, and you've probably heard this, is that unemployment is low. So people are feeling good about their jobs, but because of where interest rates are heading, home affordability and monthly carrying costs are an issue. So some of the recommendations that we're posing to you, we would ask you to take us up on this offer because we're doing this for your benefit. Certainly not for ours. So if you are renewing a mortgage in the next year or two, we are certainly recommending renewing that early. Even if there's a small penalty to pay, you will probably be renewing at about the same rate that you currently have right now. I know if your mortgage is renewing in 2023, and if you're in a 5-year fixed rate mortgage, your mortgage rate is probably close to 4% anyway. So take a jump at today's rates and renew early. If you have a mortgage and a secured line of credit, and you are not writing off the interest on that secured line of credit, because many of our clients have a mortgage and a secured line of credit, and they've used that secured line of credit to purchase other properties, and that secured line of credit would be tax deductible. But if you have a mortgage and a line of credit product, like with Scotia TD, we recommend that you pull that line of credit into your mortgage. And that's a great way just to kind of rebalance things for yourself so that you have one payment, and also the interest rate will be lower on the amortized mortgage versus a secured line of credit. For those of you who are self-employed, you may find that if you're doing a catch up on your income taxes, if you have any outstanding Revenue Canada debt, and you may have accumulated that over the last couple of years, please be sure to contact us in a prompt way. Did you know the interest rate on Revenue Canada outstanding taxes is over 20%? And even if we have to do a private second mortgage for you to clear off that debt, the interest will be a lot less, and you'll be you won't have to worry about Revenue Canada and owing money to them. My other recommendation to our clients is many of our clients, and you might be one of them, own multiple rental properties or have a rental property. Now is a really great time because the value is puffed up, even if it's a student rental, to look at possibly refinancing that rental and paying off your own personal mortgage. So what you're doing is you're converting that tax deductible debt that you have from the rental property and using that to pay off your own personal mortgage. Now, you want to run that by your accountant to make sure that they're kosher with that, but we have helped several clients just recently do that. So that's a message from our office. You know, we're here to help. I love working with people in my office. I'm just so proud of the work that we're doing. My team, Katie, Heather and Amy just do wonderful work. We are here to help. You can just click on the link below to schedule an appointment, and we continue to look forward to helping you. Have a great day.